How do you track wins and losses when markets move fast? A trading journal can be the difference. In 2024-2025, volatility rose, so did the need to track everything. This video shows how to log trades, analyze wins, and limit losses. Start with a simple, consistent journal. Traders face 5 main pain points. 1. Inconsistent records lead to unclear results. 2. Behavioral biases distort learning. 3. Lack of context, no macro annotations. 4. Poor risk management visibility. 5. No clear metrics to measure progress. Market events, rate announcements, earnings, GDP change context fast. Journals help map trades to these events. Next, we show what to record and why. At minimum, entry, exit, size, stops, rationale, and outcome. Also log your psychological state for each trade. Consistency is key, make it daily. Tech options, simple spreadsheet or cloud-based tools. Automation reduces errors and captures context quickly. Now let's dive into data. What metrics matter? Track win rate, risk-reward, drawdowns, and sector returns. Always annotate trends with arrows and context labels. Tag entries with macro events for later analysis. Aggregate daily exposure across asset classes. Compare sectors and instruments for patterns. Identify overconcentration and correlation risks. Schedule regular reviews, weekly and monthly. Use reports to see risk-adjusted returns. Log lessons from losses as much as wins. Next, a data dive, 90-shot visual storm ahead. Win rate shows frequency of successful trades. Risk-reward helps understand expected value. Track maximum drawdowns to protect capital. Annotate rate decisions. Rate shifts drive volatility. Tag inflation surprises and market reactions. Link GDP revisions to asset responses. Note labor data that changes sentiment. Record macro risk indicators like debt ratios. Annotate commodity price shocks and spillovers. Contextualize each trade with these metrics. Categorize trades by strategy for comparison. Use heat maps to spot overperformers. Timeline tags allow backtesting against events. Measure risk-adjusted returns like Sharpe. Sort trades by risk, reward, and performance. Compare sector returns across time periods. Annotate currency moves around policy announcements. AI can tag events and suggest categories automatically. Monitor curves, run-up, peak, drawdown, recovery. Automated reports save time and improve accuracy. Calculate position size based on risk per trade. Log stops and take profits transparently. Mark entry and exit points for review. Add a brief rationale, keep it objective. Tag your emotional state. It matters. Compare performance when feeling different states. Identify behavioral biases like overtrading. Use rules and size controls to reduce bias. Tag examples. USA 2024, China 2024, Eurozone 2024. Reports highlight sector and instrument profitability. Best practices. Automate, tag events, review regularly. Use journals for backtesting strategies before live trading. Simulated trades can be compared to real ones to learn. Replicate setups that show consistent returns. Filter trades by macro conditions like rising rates. Identify patterns, e.g., wins during rate hike periods. Turn raw entries into visuals to speed insights. Use filters to isolate strategies, instruments, and periods. Adjust position sizing when drawdowns appear. Set alerts for overconcentration to mitigate risk. Use a checklist during reviews to stay objective. Share journals with peers or mentors for feedback. Measure improvement after adopting disciplined journaling. Export data for performance review or compliance. Track sector rotations and position them in your journal. Use small multiples to compare instrument performance. Turn insights into action items and track them. Write a short lesson for each trade, keep it practical, flag repeated mistakes and create rules to avoid them. Isolate profitable setups for repetition. Align trades with economic calendar events. Document which sectors performed in given conditions. Note cross-market links, currencies, commodities, equities. Build a key KPI dashboard for quick health checks. Send weekly snapshots to keep your focus. Over time, you should see improving risk-adjusted metrics. A good journal helps preserve capital during shocks. Apply insights through position sizing and rules. Now let's walk through 3 real-world case studies. Examples with location tags will follow. Case Study 1, USA 2024, Rate Sensitivity and Sector Rotation. Traders noted bond yield moves affected tech vs financials. Journals tagged rising rates and helped isolate winning setups. This led traders to adjust position sizing and limit drawdowns. Lesson, tagging macro context enabled replication. Next, Asia market example, Case Study 2, China 2024, Policy Surprises and Volatility. Traders logged how policy surprises tied to commodity shocks. Journals helped identify which setups worked around these shocks. Lesson, document cause and effect for future trades. Reflective notes helped curb overtrading during spikes. Final case study, Eurozone. Case study 3, Eurozone 2024. Growth revisions and sector rotations. Traders logged market responses to GDP revisions. Lesson, contextual notes made it easier to adjust strategies. Journals helped identify correlation risks across markets. Takeaway, tag events, track metrics, apply lessons. Peer reviews uncover blind spots and improve discipline. Adjustments after reviews reduce future losses. Over time, discipline from journaling improves outcomes. Next, connecting patterns across cases. Recap, context tags, metrics, and review processes worked. Consistent, actionable lessons are critical. Turn insights into checklists and rules. Implementation proves the value of the journal. Track KPI progress month over month. Schedule weekly reviews to stay accountable. Mentor feedback accelerates learning. Let's connect the patterns. We now move to analysis, how to connect data to decisions. Analysis, translate your journal into actionable rules. Identify repeatable patterns across periods. Convert patterns into rules with clear entry-exit criteria. Backtest the rules on historical journal data. Implement risk controls. Max loss, position limits. Compare performance against benchmarks in your journal. When patterns fail, document the failure and adjust. Discipline gives a steadier equity curve over time. Monthly reviews should cover KPIs, rules, and action items. Turn insights into executable actions. Use correlation matrices to de-risk when necessary. Adjust allocations based on journal insights. The loop, log, review, learn, adjust. A well-maintained journal is a competitive advantage. Let's summarize the steps you can take today. First, record every trade. Second, tag events. Third, review regularly. Make this process part of your daily routine. Be disciplined, be objective, and use data to guide decisions. Apply these habits to improve risk management and performance. Final, a quick CTA and resources. Recap, keep a detailed, consistent journal. Tag events, track KPIs, and review with peers. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.